Jeff, we welcome you here with kind of mixed feelings. You have been right, unfortunately, for consumers. If somebody is looking to buy into the stock market, though, you have been right about where to buy on that, too. Energy prices continue to climb. Energy stocks continue to climb. You think there's any end in sight to that trend?
We're just beginning. You know, we like to argue this is the first innings of a commodity super cycle. And it's not just oil and gas, it's metals, mining, it's agriculture, because this sector has suffered from a decade plus of underinvestment. And I want to emphasize, even though Exxon's reaching, a cyclical high right now, the reality is the amount of money in this space is still very, very small. We haven't seen the rotation. The only money that's really coming into the space is share buyback. So, yeah, you're going to look at pictures that show the rotation of energy up and, tech down. But the reality is we haven't seen a big influx of capital into this space. So, are you too late in this space? Absolutely not. It's just beginning.
Is energy the new leadership then? I mean, we are talking about it getting, I think, closer to about 5% of the S&P 500. That's up from about 3.5%, but it's still far off the highs where we'd seen it, let's say, 10 or 20 years ago.
By the way, when you look at the earnings, the revenues and so forth, it's 9% of the S&P. So the fact that you're at 5 underscores how underinvested the space is, and it's a huge capital misallocation occurring. And again, it's not just energy, it's the entire old economy, because even if you want to go out and grow shale production, you're out of sand, you're out of pressure pumping capacity. All of these capital heavy industries have suffered from underinvestment, not just for the last couple of years, but in many cases going back a decade, and in some cases going all the way back to 08, 09. So, this is now payback time of, a long period of underinvestment.
What's the fastest that we could catch up in terms of what we need to be investing and then in terms of what we need to be producing?
The problem is we've now entered this volatility trap where the higher the volatility, the less incentive people have to put money to work in this space, which then exacerbates the problem and creates this vicious loop in which it reinforces higher volatility. And so the question is, what's going to stop this? What's going to, high returns can be the one that does this. But at this point right now, they're not high enough to get people to go into this space. When I go out and I survey investors as to why do they not want to put money into this space, reason number one, a history of poor returns. And, less than 2 years ago, the losses in this space were nothing short than epic with negative oil prices. Reason number two, the volatility is too high. They don't want to actually contend with, oil prices, just a few months ago we're at 98, and then they're at 122, 140, back to 98. I think you get the point. Volatility is high. And then, reason number three is ESG. ESG is actually well below, just the history that the space has. And so I ask, what's going to get capital to come back in the space? The answer is a 3-year track record within the space. And we're about 18 months into that track record.
The administration has all kinds of plans to try and bring down inflation. I don't know that anything they've said so far is going to do anything to impact prices, particularly at the pump or in grocery stores anytime soon. Gina Raimondo, the Commerce Secretary, made the comments the other day that, in all honesty, there's nothing the administration can do. Is that correct? Is there something they could be doing to change things?
The problem is it's a global problem. And it's combined very much in with climate policy. So it's climate as well as energy put together in the current environment. And so one country creating an environment to try to solve a global problem, because what makes commodities very different than other asset classes and other sectors is they're truly global in nature and they're very fungible across the world. So the policy of one country impacts the global market very small. You got to have a more global policy in approaching this in a very systematic way. Because and you look at what Germany's doing right now, the impact that Germany's having on the global market is significant. They've turned back on coal plants. You're importing coal from the United States, which is putting support into U.S. natural gas. So this cannot be done in isolation. And obviously, I'm talking about something that's incredibly difficult to deal with, but the policy needs to be really global in nature to actually really deal with this problem.